Let me first of all extend a very warm welcome to Dr. Indrajit Coomaraswamy on behalf of Senfin Securities, and also thank you for accepting our invitation and joining us today in the evening to share your insights, which I'm sure will be immensely valuable to all my colleagues. So, of course, Dr. Kumaraswamy is not someone that needs any introduction, but nonetheless, let me give a small, very brief introduction, because if one is to give a proper introduction, I suppose we'll have to have a separate session on that itself, because his career is an illustrious career that spans multiple years and a lot of great work. So, without further ado, Dr. Indrajit Coomaraswamy holds a Bachelor of Arts Honours in Economics and a Master of Arts in Economics from the University of Cambridge and a Doctor of Philosophy in Economics from the University of Sussex. As we all know, Dr. Coomaraswamy is the former governor of the Central Bank of Sri Lanka. He was also a member of the Monetary Policy Consultative Committee of the Central Bank of Sri Lanka from 2013 to 2015. And he was also an advisor to the Ministry of Development Strategies and International Trade from 2015 to 2016. Prior to this, Dr. Coomaraswamy held several senior positions in the Commonwealth Secretariat in London. He joined the Commonwealth Secretariat in 1990 as Chief Officer Economics in International Finance and Market Section, and progressed to become the Director of Economic Affairs Division and Deputy Director, Secretary General's Office, before leaving in 2008. He was a non-executive independent director of John Hills Holdings PLC, Dialogue Asiata PLC, and currently serves as a non-executive director of Tokyo Cement PLC. Welcome, Dr. Coomaraswamy. So today's event will be of twofold. So the first part of it, Dr. Coomaraswamy will share his insights on the topic of Prosperous Sri Lanka and Wealth for Sri Lankans, which will be followed by a Q&A session, which will be mostly focused on the budget 2025. So, Dr. Coomaraswamy, over to you.
Thank you very much, Dasan, and let me say it's a great pleasure to be with all of you this afternoon. On the theme for my remarks, what I'm proposing to do is to have two kind of themes that I want to expand upon. One is the repeating bouts of macroeconomic stress that we've had, which has resulted in Sri Lanka having 17 IMF programs. And secondly, also to make the case for developing a new growth strategy, a new growth model, which gives us sustained growth based on export transformation. So those are the two kind of themes I'd like to expand upon. But by way of introduction, I mean, I don't need to tell all of you, you know better than I do, that we've had extremely impressive stabilization of the economy from where we were 3 years ago. The Sri Lankan economy has performed better than anybody expected. But, you know, we've been here before, in the sense that even in the earlier IMF programs, 17, I think we completed about a dozen. We did the stabilization part, okay. Otherwise, we wouldn't have completed the program. But somehow we don't get the structural reforms done. And then, when elections come, governments try to take shortcuts. And they try to boost growth through unsustainable macroeconomic policies to try and get a sugar high for the election. And then after the election, again, the economy, the imbalances become too great, and you have elevated inflation, you have pressure on the exchange rate, and we have to go back to an IMF program. So, have we broken that repeating cycle? And I'm going to try to make the case that we have. And if we are to have sustained prosperity in the country, I think you have to create a stable foundation. And a stable foundation is strong macroeconomic fundamentals, which we have not been able to achieve on a sustained basis. Okay, what is different this time? So I am saying that we've stabilized before, but then that it could not be sustained. What is different this time? So if you recall, the causes, the root cause of our macro instability has invariably been the government's budgetary operations. From time to time, there have been exogenous shocks also, which have caused imbalances in the economy, but most of the time, it's missteps, domestic policy missteps, starting with the budget. Particularly as I said, as elections approach, the budgetary discipline slips and the deficits are enlarged, and that creates excess aggregate demand in the system. So consequently, you have elevated inflation, and some of the excess demands translates into demand for imports, which also puts pressure on the balance of payments. And then when the FX situation becomes completely unsustainable, we go to the IMF. So that's been a repeating cycle. Several rounds of this have taken place under all governments. So what has been done to break that cycle? And here I want to make the case that we now have a new paradigm for macroeconomic policy making. And that new paradigm has two pillars. One is the Public Finance Management Act, and the other is the Central Bank Act. So, taking the Public Finance Management Act, you have, in the past, under the old Fiscal Management Responsibility Act, also we had a fiscal rule. The rule, I think, was 70% of GDP for government debt. But when it was set in 2002, when the act was passed in 2002, the target was set about 10 years further down the line. Subsequently, each time the deadline came, Parliament just postponed the deadline. And so the fiscal rule was utterly ineffective. But now, under the Public Finance Management Act, the rules have to be met every year. So you have to have a primary surplus of 2.3% every year. You have to have revenue of 15% of GDP and a primary expenditure target of 13% of GDP. So the rules are much, much tighter. And of course, if you deviate from those rules, you are actually breaking the law. So having a clear framework for fiscal policy and embedding it in the law is something entirely new. Then, what used to happen, in addition to the kind of unsustainable budget deficits, on the central bank side, there was fiscal forbearance in monetary policy. And there were two channels through which this fiscal forbearance was materialized. One is deficit financing, and the most egregious form was the central bank's participation in primary auctions. That was basically just creating hot money. And the second, and of course temporary overdrafts. There are various ways in which the central bank lent money to the government. Now, under the new Central Bank Act, by law, the central bank cannot fund the government. So the government has to stand on its own 2 feet. So that form of money creation is no longer possible. Equally, there was also the second channel for fiscal forbearance was financial repression. The central bank could artificially manipulate the interest rate structure and bring it down. One, to create cheap money for the government, and two, to try to create a sugar high in growth, unsustainable sugar high in growth, invariably before an election. So that both these things are no longer possible. The Central Bank Act prevents deficit financing of any sort to the government, temporary overdrafts, primary auctions, nothing. And also, as far as financial repression is concerned, the interest rates are now set through a flexible inflation targeting regime. So the finance minister sets the inflation target in consultation with the governor, and then it becomes a data-dependent, forward-looking regime driven primarily by inflation expectations. And so it's data-driven. The central bank has improved its modeling and forecasting capability, etc. So there is no scope for artificially setting the interest rates in an administrative way. You have to set it through this flexible inflation targeting framework. So that when the fiscal forbearance was there, in addition to excess demand being created by large fiscal deficits, these monetary operations of the central bank, or the monetary policy operations of the central bank, also created excess aggregate demand. So you had this, everything coming together to push up inflation and to put pressure on the balance of payments. So now, because those, the budget fiscal rules have been tightened, there's a clear framework for monetary policy formulation, which prevents the earlier forms of fiscal forbearance in monetary policy. All this means that the chances of having this kind of excess aggregate demand being created through fiscal and monetary policy is now greatly reduced. In fact, if you stick to the law, then it's unlikely you will get this repeating macroeconomic stress. And what does that mean in practical terms? It means that interest rates should be more stable and lower, generally, and the exchange rate should be more stable. It would be more volatile on a day-to-day basis, because under the flexible inflation targeting regime, the exchange rate is the first line of defense for any kind of pressure on the external side. So the exchange rate has to be managed flexibly and based on the supply and demand dynamics in the FX market. Now, our market is only 60 million. So you will get movements up and down. And on a day-to-day basis, you could see the exchange rate moving around. So earlier we used to try to fix the rate. But now what you will see in practice is more movement of the exchange rate than in the past, but it will be within a much narrower range. You're not going to have this kind of, the playbook in the past was when the exchange rate came under pressure, we basically tried to defend the indefensible by depleting our foreign exchange reserves. So eventually there was always a double whammy. So you find that at the end you have to depreciate the currency pretty sharply, and at the same time you've lost your reserves as well, part of your reserves as well. So that kind of double whammy now should be not possible. So in terms of preserving the people's wealth, you will have, I think, a more stable exchange rate within a band, and not an artificially created band, but in terms of market dynamics, the exchange rate should move within a fairly narrow band, but moving up and down, reflecting the day-to-day supply and demand dynamics of the exchange rate. So if you take all this together, I think we have cracked the problem in terms of repeated bouts of macroeconomic stress. Now, from business point of view, managing on a day-to-day basis can be a little bit more difficult than in the past, because there will be these movements on a day-to-day basis, but you won't get this dramatic depreciation of the currency or sudden elevation of interest rates. So in that sense, it's a much more stable environment for business, and a more predictable environment to do business in. So that's all very positive. But what this has done, in my view, is created a good, stable foundation. But while a foundation is critical, you have to build a house as well, right? And there we've barely scratched the surface. Question is, have we done the structural reforms to make sure that we have this new growth model, which is based on export transformation? Now, way back in 1978, J.R. Jayawardena said, export or perish. Now, we have had periods where we have done some reforms, but they've invariably been partial, and often they have been reversed. So from 2000 onwards, if you look, we have actually fast-forwarded in the wrong direction. In 2000, exports of goods and services as a percent of GDP was roughly about 35%. Today, it's about half that, right? Despite saying export or perish, we're actually half where we were in 2000. Equally, in terms of the openness of the economy, that's exports plus imports as a percent of GDP. In 2000, it was about 75%. Now it is closer to 35, again half. And in terms of the benefits of openness, you only have to look at China. The coastal regions of China, which are integrated with the global economy, more integrated with the global economy. They've prospered far, far more than the hinterland, which is far more closed. That in itself shows you the benefits of openness. Now, of course, the world economy has changed and is continuing to change, etc. It's a different global landscape. But that basic point that openness has given dynamism to economies is a valid one even today. And particularly if your market is only 23 million people, based on a purchasing power of 4,000 USD per capita. So, really we have gone completely in the wrong direction over the last 25 years. I mean, there were periods where things have changed a bit or not, but the overall thrust has been entirely in the wrong direction. So we need to create, first is to address the anti-export bias in our basic policy framework. For instance, the level of protection is channeling resources into the non-tradable sector. And the exchange rate has often been overvalued, which means that we are actually subsidizing foreign producers at the expense of domestic producers. And we have excluded ourselves from the most dynamic component of the international trading system, which is these global supply chains. Because once you put a para tariff like PAL or CES in the middle, you become uncompetitive, because the system of global production networks is that the material comes in, you do your little bit and you put it out. But if you stick a para tariff in the middle like CES or PAL, because the margins are so fine, you exclude yourself. So as a result, intermediate exports, that is, basically material coming in, the country doing its bit and sending it out, is less than 5%. In Malaysia, Thailand, I believe it's more than 50%. So we've, as I said, cut ourselves away from the most dynamic component of the international trading system, which is cross-border supply chains. So those things we need to put right. And also we need to do basic reforms in terms of improving the competitiveness of the economy. Way back in the 1980s, I was seconded from the central bank to the finance ministry and became the bag carrier for the finance minister at the time, the late Mr. Ronnie Dimel. So I used to wander around with him and listen to his speeches. And what he said about structural reform is exactly what we are saying today. So reform factor markets, reform SOEs, improve the investment climate, improve investment promotion, strengthen trade policy including trade agreements, strengthen trade facilitation, education, training and skills development. The agenda has not changed. We've done a little bit here and there, but as you've seen from the trends in exports and in the openness of the economy, we've done remarkably little. Then you have to ask the question, people in this country are smart enough, why is it that we haven't been able to do this? Because lots of other countries have managed it, particularly in Asia. Lots of countries have been able to create a growth model based on export transformation. And most of the time it's been driven by FDI. You don't see export transformation without FDI and the capital, the markets, the know-how it brings. So why is it that we couldn't get this done? And I can only think of two reasons. One is the gestation period for payoff from structural reforms is relatively long, and it is often more than one political cycle. So there is no incentive for politicians to get these done. The second and most probably significant response is, while these reforms have many winners, they also result in some very, very powerful losers. Few of them in number, but they are very powerful because they have a strong vested interest in the status quo. So clearly, they resist. And it could be businesses, it could be trade unions. So people have been very successful in resisting structural reform. So why is it so important that we have now really a laser-like focus on structural reforms? There are two reasons. One is, as you know, poverty has increased dramatically. Within 2 years, the income poverty doubled. The Sri Lankans have been, and I think as far as multidimensional poverty is concerned, I think over 50%. And a UNDP study found about 55% of the people are multidimensionally vulnerable. So, the Sri Lankan people have been extraordinarily patient so far. But Whether they will be patient, how long they will be patient, unless they see some material improvement in their living standards, is clearly a question mark. And at some point, they're going to lose patience, and there will be the prospect of political and social unrest. So you need growth quickly for that. The other reason is, in 2028, we need to be able to A, repay our debt obligations, because right now we're not paying the capital on the commercial debt. We've serviced multilateral debt throughout, and now we've started to pay interest on bilateral debt and on the ISBs. But from 2028, we'll have to make the capital repayments as well. We'll have to meet the higher debt servicing and finance all our imports. So that's a crunch time. And in all, the central bank reckons to make sure that we are sustainable in terms of debt, we need to have a 5% plus growth. So that's a challenge. Now, the last few quarters we've been getting 5% growth. So one could think, we're getting this anyway, what is the big deal? But that 5% growth in last few quarters is based on two transitory factors. One is, the economy went from peak to trough. There was a 10% decline in GDP. And the economy went from contraction to expansion, I think, in the third quarter of 2023. So for the 4 subsequent quarters, we had a very strong base effect. And that helped to get the kind of 5% growth we got in 2 or 3 of those quarters. Then subsequently, there has been considerable underutilization of capacity, partly because of import controls, lack of confidence, lack of demand, etc., domestic demand, etc. So you have this spare capacity that was there, but with the debt restructuring being completed, with the IMF program progressing, with the rating being upgraded, now you're beginning to see private sector credit flow and capacity utilization increasing. So that again gives a boost to growth without the need for additional investment. But once the level of GDP comes back to where it was before the crisis, i.e. once you make up the 10% contraction, then you will need new capacity, new investment. So we'll probably be able to catch up by the end of this year. We got 5% growth last year, 4.5 or so this year, so 9.5, we are almost up to 10. Then once the level of GDP has been regained, then you will need new capacity and new investment. It becomes much more difficult to sustain the 5% growth. So that's the critical thing now. So if we are to kind of create a wealthy country and prosperous country, etc., we have to continue with the new macroeconomic policy making paradigm, and we need to get the structural reforms done to have 5% plus growth.
Thank you very much for your valuable insights, Dr. Coomaraswamy. So, like you enumerated, I suppose the challenges faced by our economy are nothing new, and in fact, we've known what the solutions are also for decades. But however, certainly we are at a crucial juncture, and hopefully we have enough incentive to get things right this time. So, having said that, in February, the new government presented their very first budget. So, I am in receipt of questions from the audience which revolve around the budget and somewhat does even touch upon some of the areas you already enumerated. So in the interest of time, so if you could briefly answer these questions so that we could give more clarity to their questions. So the first question is related to the fiscal deficits that you also touched upon. So the budget projects a fiscal deficit of 6.7% of GDP, which is exceeding the IMF's target of 5.2%. So what are the potential implications of this discrepancy for Sri Lanka's economic stability and also its relationship with international creditors?
Hello, I'm sorry. In terms of hitting the target on the budget deficit, we do have some flexibility in the budgetary numbers. What Sri Lanka normally does when there is a problem of this nature is that we reduce capital expenditure. This time we have relatively high capital expenditure. It's 4% of GDP. I think it's unlikely, even if we didn't need to cut it, we will be able to hit the 4%. Last year it was 2.5% of GDP, but of course we had 2 elections, which invariably disrupt government operations. But despite that, I don't think we'll get to 4% of GDP. So that gives us some flexibility in terms of the overall budget deficit. I don't anticipate us having difficulty in not meeting that. Also, there is, in my view, real scope to increase revenue even without touching the tax structure as it is. I do think there is scope for more taxes, and eventually we'll have to have it. But right now, if you just take the current tax structure, we can still do better for this reason. One, until 1997, Sri Lanka collected over 20% of GDP as revenue every year. After that, we started giving these tax holidays and various things. And maybe there was a rationale for doing that when there was a very high war risk premium attached to the economy. But the war has been over for a long time. And I really don't think we need to give any tax holidays. If companies are making a profit, they should pay tax. And if you want to give some incentive, what Mangala Samaraweera started to do, but which was discontinued, I think he introduced it in 2018 in the IRA, is to give investment allowances, to give upfront relief to link to capital formation. But once a company is making profits, I see no reason why it shouldn't pay profit, but pay taxes. So there is that leeway. But the real kind of potential is with technology. That is RAMIS, the Revenue Administration Management Information System in IRD, and the single window in customs. And also excise, there is scope because there are a lot of corruption. If you read the IMF governance diagnostic, they talk about the 3 revenue agencies as being unbelievably weak in terms of corruption vulnerability. And the Singaporeans gave us this RAMIS, Revenue Administration Management Information System, I think well over 10 years ago. But it has not, there has been resistance against implementing it. What is, in my view, interesting about it is that while there may be various ways you can hide revenue, it's much more difficult to hide expenditure. There's no point in getting revenue if you can't spend it. So what RAMIS does is that it links all the government agencies responsible for large transactions, like the land registry, like the condominium authority, like the RMV, like the company, register of companies. All these institutions are linked directly, can be linked directly to IRD. So any large transaction that takes place in the country, immediately, in real time, IRD gets to know about it. Then of course they can check and see whether that person who has spent all this money has a tax file. And also to see whether the amount of money he or she has spent is actually commensurate with the kind of income they are declaring. So it will actually, I think, significantly improve revenue collection. But there has been a problem in terms of getting the IRD people to accept it. Equally, the single window in customs. Again, if we implement these technologies, I think we can get much more revenue. And the revenue, the fiscal rule of 13% of GDP for primary expenditure is very tight. But it is based on a macro fiscal framework which has revenue as 15% of GDP. But I think if we do all these reforms in terms of technology, we can collect a couple of percent of GDP more. I really think there's enough you can pick up. And maybe also to perhaps tax the higher income groups a little bit, because then there's a danger that you lose a lot of people with skills. But even without that, with improved tax administration, you can increase. And that, of course, gives you leeway to increase the expenditure target as well. So, yeah, so there's scope to increase revenue.
So, touching on the subject of revenue, in fact, the next question is also specifically something you mentioned regarding revenue to GDP. So, the government's target is to raise the revenue to GDP to 15.1% in 2025. So, could you tell us a bit about what specific measures have the government proposed in the budget? And in your opinion, how feasible are they in the current economic climate?
Yeah, I think it's pretty feasible because I think last year, if I'm not mistaken, it went up to about 14%, if I'm not mistaken. So an additional percent of GDP is, I'm pretty sure, possible given the present structure of taxes. I think it is essentially programmed to reach that 15% of GDP target this year. I'm pretty confident they'll do it because there is improvement in tax administration even without the technologies and the tax structure, and also now the tax concessions are being reduced dramatically. I think outside Port City there's very little that's being given. So all in all, I'm pretty confident they'll get the revenue target. And as I said, if there is a little bit of a problem on the budget deficit side, there is some fat in the capital expenditure that can be used to address that. Mind you, the government will be very keen to spend the 4% because if their priority they're giving to growth. Really, if you don't spend the whole 4%, that will have a negative impact on your growth rate.
So, speaking of the spending side, so you slightly touched upon the capital expenditure part of it, but then also speaking of spending, I believe welfare payments also are a significant component. So the budget has also allocated significant funds for welfare as well as infrastructure. So how efficiently do these allocations address the immediate needs of the population while promoting long-term economic growth?
So in an ideal world, clearly it will be good to spend more on education, health, and social welfare, and all these things, right? I mean, our big problem is that we have no fiscal space, given the history of our fiscal performance. But I think within the constraints that are out there, I feel the government has done pretty well. I mean, they've got, I think, a record level of health expenditure. They've increased the education allocation. Of course, one could argue that it should be more.
Yeah.
And I agree it should be more, but given the hand that we have, not that we've dealt with, that we've created for ourselves, I think that's positive that they've been able to increase the allocations for health and education. And of course, on social welfare, the aspirational allocation has been increased. I hope the targeting has also been improved. I think they're trying to do that. And what is good is that they've now got the right instrument for welfare payments, and that is the cash transfers. In the old days, if you remember, we had untargeted subsidies for electricity, fuel, all these things. And there was tremendous amount of evidence that they actually benefited the non-poor more. So it was completely the wrong instrument. It ended up, A, benefiting the non-poor, B, putting pressure on the government budget, and often on state bank balance sheets. Because the government essentially got the Petroleum Corporation and the Electricity Board to subsidize fuel and electricity. And so those subsidies were then transferred onto the books of the state banks, and the government didn't give them the money. So, but of course there is a zero weighting on government entities as far as risk weightings are concerned. But in effect, they undermine the balance sheets of those state banks. So, using the right, the allocations within the constraints have been increased, and that's very positive. And also the right instrument is now being used for welfare payments. Of course, there's inclusion and exclusion problems to do with the program, which can be improved, but at least we've got the right instrument to to finance our social welfare programs.
So another area which caught a lot of attention in the budget is the proposed increase in minimum wage for the public sector employees. So it was actually a substantial hike from rupees 24,250 to 40,000 rupees. So what impact might this have on the national budget and inflation rates?
Okay, one thing to remember is that it is coming in 3 phases, right? It's not coming in one shot. The other thing is, if you read the final press statement of the IMF team when they came last time, they said, okay, there was staff level agreement on the review, but there were some prior actions. And the key prior action was the budget. So the IMF would have vetted the budget to make sure that it's aligned with the trajectory of the program. So all these measures in terms of salary increases and the various allocations, etc., the IMF would have kind of looked at it and validated it as being within the program.
Okay.
Otherwise, they wouldn't have completed the program and given us the money a couple of days ago.
And so you mentioned that come 2028, we need to start repaying our debt. And in fact, President Andrakumar also announced the government's intentions to start debt repayments come 2028. So the question is on what strategies are in place to ensure this commitment is met without compromising economic growth.
Okay. So the macro fiscal framework that is embedded in the IMF program, if we see the program through to its end, is intended to achieve debt sustainability. But that framework assumes a growth rate of only 3%. In my view, it's dodgy. If we only achieve 3% growth, I'm not sure we will be able to pay our debt and finance our imports. I think we need to get at, central bank itself said then we need to get at least 5% plus growth. So in terms of preparing for it, the best way to make sure that we don't have to have another debt restructuring is to get more than 5% growth with a strong orientation towards export transformation.
Okay.
So that you increase your FX inflows as well. Of course, if you have stable macro policies and a framework that gives assurance that in the medium term you're going to be able to keep that the macro fundamentals strong, then you will also get FDI flows, portfolio flows, other non-debt creating flows, which will also help you in terms of having the FX to service the debt and finance your imports. So it really, we have to, in my view, whether we really make it or not, depends a lot on a very laser-like focus on structural reforms and getting that growth rate up. And taking away the anti-export bias in our policy framework so that resources are channeled into the tradable goods sector.
So, given the recent history of high inflation, so what are the policies that you see in the 2025 budget that will actually support in helping to maintain low and stable inflation rates?
So as I said, the macro fiscal framework in the IMF program is intended to achieve economic stability, macroeconomic stability, as well as debt sustainability. So if we stick to the program, then by definition, we should be able to have strong fundamentals which don't lead to an elevation in inflation. So if we get right to the end of the program, hopefully inflation will be low. In fact, say even in the last EFF that we got in 2016 and implemented till just before the last review and installment, inflation was pretty low. I think, if I'm not mistaken, in 2019, inflation was again well below the target at the time. So if you stick to the program, inflation will certainly will with. I mean, the central bank reckons the current low inflation is partly due to administrative prices like the electricity and fuel, which have been, particularly electricity, I mean, on the basis of the formula, they've been reduced. Maybe electricity has to go up a little bit, but generally the new formula has enabled them to reduce the electricity and fuel, which has helped to keep the headline inflation rate down. But the central bank reckons by the middle of the year, we will start moving up towards the 5% inflation target. And I'm sure the central bank will have a very keen eye on where there are inflation projections and where they think inflation will be in 12 to 18 months' time, because monetary policy transmission has a lag of 12 to 18 months. So you have to set monetary policy today for what you think is going to happen a year to 18 months ahead. So they have, I have a lot of confidence in the governor, by the way. I mean, I worked very closely with him. I used to rely tremendously on him. Even when it comes to monetary policy and the exchange rate, I mean, he's way ahead of anybody else in the country. So as long as he's there, I'm confident he will manage it in the way it needs to be managed.
That is certainly very good to hear. So the budget also emphasizes support for small businesses, particularly key sectors like tourism and tea. So how might these stimulate these industries and really help achieve growth that we speak of, the 5% growth that we must hit in order to stay within the program, as well as to be able to start repaying debt come 2028. So how will these support programs that are proposed in the budget help towards that?
Okay. So I think one crucial thing is to have a stable macroeconomic fundamental, right? So if you have much less volatility in interest and exchange rate, that helps everybody, including MSMEs. The second thing is that the government is keen on increasing the capacity for development finance. Now, the problem there is the maturity mismatch. You know, when we had the NDB and DFCC, they were able to function because at that time, the World Bank and ADB gave very long credit lines, very long-term credit lines. So that money came to the government and then they disbursed it through NDB and DFCC. And that addressed the maturity mismatch because we were getting long-term money and we were able to lend 5-7 year maturity. Now we don't have a long-term money. Banks are mobilizing 1 year deposits basically, or pretty much that. And then we are asking them to lend 5-7 years. Clearly the risk mismatch is a significant problem, and however much we urge them to do it, they will be very reluctant to do it, simply because their risk managers will find it a serious problem to do very much of it. So we have either the bank, government has talked of creating a new development bank. Tricky thing about that is, to get the people and the overheads, the capital, all that becomes the problem. In my view, and the Yahaprana government started to do it in under Mangala Samaraweera, is to try to get some long-term money from either ADB or Japan. I don't think the World Bank will do it, because these development banks were all knocked out during the Reagan-Thatcher era. During that Washington consensus, ideologically they thought this long-term financing was not something that should be done by those institutions, and they stopped it.
Okay.
So, but hopefully the ADB might have flexibility to do it, and the Japanese government is another possibility. So we need to get long-term finance and get the credit flow going there. But more than anything, and also this parate, suspension of parate only serves to reduce the availability of credit and increase the cost. So I hope that that's overturned. I'm told it might well be over. The decision to suspend it will be overturned soon. But more than anything, you know, for MSMEs, there are 4 areas where you can intervene. One is training. 2 is access to inputs and technology. 3 is credit, which is what the development bank is supposed to do. But most crucially, it is markets. To link these enterprises to supply chains and to give them market access. That is the most intractable problem. If you're able to clear the marketing channel, you will get credit. No banker will, refuse credit to somebody who has a market to sell his or her product. So we need to really have a laser-like focus on clearing market channels. It could be the local polar, it could be the global economy. But we need to help MSMEs with their marketing channels. And equally, the formal sector companies need to develop these supply chains. And the supermarkets and even others. Already we do have very good examples. The Haley's companies in the rubber sector. There are a number of companies which have these, what do you call this, what farming is it? The nuclear farm and something that they have the outgrow systems, etc. So there are good examples. We need to essentially replicate and expand those kind of things. Yeah.
You mentioned of the need to focus on an export-oriented growth. So in fact, the government has also mentioned its intentions of expanding Sri Lanka's network of free trade agreements, particularly with that of the ASEAN nations. So how might this influence the country's trade balance, as well as how will it influence the local industries?
So essentially, depending on who you're negotiating with, for instance, India, in the bilateral agreement we already have, they have set aside the principle of non-reciprocity. So our negative list is much longer than theirs, and our positive list is much longer than theirs. So in that sense, or India's positive list is much longer than our positive list. So we have to, if we are negotiating with much larger, much stronger economies, then we need to be conscious of that principle of non-reciprocity being calibrated to reflect the relative strength of the economy, and we need to negotiate very well. But actually, with a market of 23 million people, as I said, purchasing power $4,000, there is some, free trade agreements is one way of expanding our markets. And our private sector